Hey guys, how you doing? Welcome to the foundations of Forex trading. In this two-day training, what we want to do is to take you through the basics of trading in the foreign exchange market. So we'll be starting from the basic nitty-gritty of Forex trading and get you up to a point where you're able to make very, very good decisions, placing trades in the foreign exchange market, right? My name is Toby Okunoga, and I welcome every one of you here tonight. This particular bootcamp is powered by 10 Trade. 10 Trade is a fantastic forex broker, leading forex broker in the forex space today. Okay, so without further ado, let's go straight into the content of this session. Now, the first thing that we'll be talking about, so let me share my slide right there. The first thing that we'll be talking about is what Forex is, right? What is Forex? Okay. Now, Forex is an abbreviation of foreign exchange. So if you hear anybody say Forex, okay, so Forex stands for foreign exchange, right? And the foreign exchange market, it is the largest financial market in the world. And every single day, the transaction that goes on in the market is averaging $6 trillion. So that means there are times that every day it is more than 6 trillion. There are days that it is less than $6 trillion, but averagely it's about $6 trillion in transactions. Okay, so that's the amount of money that flows in and out of the foreign exchange markets on a daily basis, right? Now, the Forex market is open 24 hours a day, 5 days a week. What that means is that the Forex market is only open Mondays through Fridays. Now, on Saturday and Sunday, which is a weekend, the Forex market is closed, right? So just like you would have your average brick and mortar business open on Monday, close on Friday. Likewise, the currency market, which is a Forex market, opens Mondays through Friday. Okay. Now, you might be saying, if we call it a Forex market, is there like a physical location for the Forex market? This is for people that are used to going grocery shopping or going to the farmers market. Unlike all of that, the foreign exchange market has no physical location. Now, the forex market, in the forex market, trading is conducted through what we call electronic communication network, okay, called ECN, in various markets across the globe. So there's a lot of networks, a lot of interchanging network that makes the forex market an exchange. Okay, so and every transaction in the foreign exchange market is processed through that interconnecting network. Okay, so all of this should give you a bit of background about what the foreign exchange market is all about. Now, as you follow through, I'll be unfolding some major concepts to you, and everything will be a lot clearer. Okay, so let's talk about what we call CFDs. Now, once you start trading in this space, you start coming across what we call CFDs, which is contract for difference. Now, the major reason why you're learning how to trade Forex is so that you can, make some money, right? So it's a skill set that will help you make money, right? Now, when we talk about contract for difference, now this type of financial instrument allows you to benefit from fluctuations in the price of stocks, commodities, indices, and more without really purchasing them. So let me give a practical example. So in the foreign exchange market, as you will learn, what is traded in the market are currencies. Currencies like your US dollar, like your British pound sterling. Now, because the Forex market is run online, it's an online trading, right? Because of this instrument called contract for difference, if you are trading, for example, the Euro USD, which is the most popular currency pair, If you are trading Euro USD, you wouldn't need to actually have physical paper currency with you, right? So all of that is done online, and it is made possible because of what we call contract for difference. So you don't own the asset you trade. Everything is done online, okay, leveraging on some middlemen, which we'll talk about. Okay, so you can buy a particular currency pair and then you make money once there is increase in that price. You can also sell or go short. And once price goes lower, okay, you can make profit, right? So regardless of the direction in which price is going, either price is going up or price is going down. If you take entry on the right side of the market and then price goes your way, you will make profit. So in essence, either price is going up, you can make money, or price is going down, you can make money. And all of this is made possible because of what we call contract for difference. You don't need to have physical paper money, right, to trade in the foreign exchange market. Okay, so let's talk briefly about um, comparing the stock market and the forex market. Now, pretty much everybody knows what the stock market is. So you might be wondering, is the forex market the same as the stock market, or let's say the crypto market as well? Okay, we should add the crypto slightly to this as well. Okay, but let's do a bit of comparison. Now, in the foreign exchange market, what we trade in the forex market are currencies, while in the stock market, what is traded are company stocks, stocks of big companies that have gone public. Okay. In the Forex markets, the instrument that we are trading are currencies, okay, currencies of countries. Okay. Meanwhile, in the stock market, what is traded are company stocks. All right. So take a look at what is going on here. Now, when you compare the Forex market and the stock market, you will see that the Forex market you see why it's the largest financial market because of the daily trading volume that goes on in the foreign exchange market, right? The first market, as we've learned, is averaging 6 trillion US dollars on a daily basis. Meanwhile, the largest stock exchange in the world is the New York Stock Exchange. And New York Stock Exchange is averaging about $22 billion every day. The Tokyo Stock Exchange is averaging 18 billion daily. London Stock Exchange is averaging $7 trillion daily. Okay. Now, when you compare the stock exchange to the Forex market, it's like comparing a giant to a midget, right? So ideally, you should have more opportunities, but this does not mean that in the stock market, you also can't make a lot of money, right? So there are opportunities each of these in each of these markets, either the forex market, the stock market, or the crypto market. On the other hand, the cryptocurrency market is also a financial market. Uh, the crypto market right now is approaching, if not more, right now than down $1 trillion in total market cap. Right. So in the cryptocurrency market, what is traded in the cryptocurrency market are majorly crypto pairs, cryptocurrency pairs, tokens, and things like that, right? But for the purpose of this training, we won't really focus, we won't go deep into every other aspect. So we'll deal majorly with forex trading. And then I'll also show you how you can also be a part of the stock market, also be a part of the crypto market as well, leveraging on 10 Trade. Now, 10 Trade is a platform, is a brokerage firm that gives you access to trade, stocks, okay, crypto, okay, on CFDs, right? Good. So let's talk about the market participant. The market participant. Now, you just learned that the Forex market is averaging $6 trillion on a daily basis. Now, you think to yourself, who are the people responsible for the transaction on a daily basis? Who are the people playing in the Forex market? Who are the market players? Okay, you can look at it like that. Who are the people contributing this $6 trillion? Now, we have hedge funds, which are financial institutions that trade very, very large capital. Okay, so hedge funds, an average hedge funds is trading over $1 billion US, and then we have several hedge funds in the world. Okay, so hedge funds take investors' money or their money, trade it in the forex market in hopes to make profit. Now, you also have central banks. Every country should have a central bank. Okay, so they are constantly leveraging on the market as well to improve their currency. Okay, you have commercial banks as well. Okay, you have forex brokers. Forex brokers like 10 Trade. We have a lot of forex brokers. They are also market players. They give you and I, individuals, access to trade in the foreign exchange market. Then you also have companies that trade in the markets. You have individuals. So, and then of course, without leaving out, government as well, government of nations also has a stake in the foreign exchange market. So when they bring their capital and then they try to invest in the market, try to take advantage of currency moves, okay, they also contribute to the daily transaction that happens in the market. Now, because of the large volume of hedge funds, central banks, commercial banks, forex brokers, level of transactions, they tend to have a bit of how do you put it? A bit of stake to determine market movement, right? So hedge funds, central banks, they have they play a big role in determining the direction of price in the market, right? Because they are trading huge funds. Now, remember, we said that the Forex market is averaging $6 trillion, right? Now, there are really, really large hedge funds, asset management firms that have high capital, that has serious money that they're investing. So let's say a hedge fund is investing, let's say $10 billion, for example, in the first market. Now, $10 billion for a big hedge fund is not so much money because they're handling a lot of money. An average hedge fund is trading mutual funds, trading pension funds. So they are handling a lot of money. Okay. So if the market is averaging $6 trillion on a daily basis and one hedge fund in a particular day is putting into the market $10 billion, believe it or not, that input in the market at that particular point in time would have an effect on market price. So they can actually influence the price of currencies in the market, right? Now, the market participants at the lower end of this are the individuals, retail traders like you and I. A retail trader is an average person looking to trade in the market, funding as low as, let's say, $500 or even $1,000, right? People that are not trading yet in the realms of millions of dollars, you are individuals, right? So when you put your little money in the market, right, you do not really have a lot of leverage. Okay, let's put it that way. So your trade in the market cannot really move price, Okay. So as individuals, the best thing that you can do is to learn how to figure out the footprint of these hedge funds, central banks, commercial banks, the markets, the big financial institutions, know where they are tending to push price to, and just simply follow the money. Okay, so that's a skill set that you will have to learn. And then in the course of this 2-day program, we'll give you some pointers as to show you things that you can, put together to figure out exactly where price would get to or go to so that you can be a part of that move. Okay. Forex brokers are some sort of middle man that gives you as a retail trader access to trade in the financial market. Okay. So this is a slide about foreign brokers, right? Now, a broker gives you as a retail trader, right? You are trading in the financial market, leveraging on the brokerage firm. Now, a while ago, it was practically impossible for the average person to trade in the foreign exchange market. I think at that point in time, there was a cap or a minimum that you could have to trade in the market. Okay. I think the minimum was about 100,000 US dollars. And then when you have that, you can trade directly, okay, in the market. There's a system that was in place at that time where your investment is going directly into the market. But right now, for the advent of forex brokers, made it easier for the Joe anywhere in the world to trade in the foreign exchange market. So the broker gives you that leverage. Remember, I said that minimum that you need at the time was $100,000, but pretty much not everybody has $100,000 to trade. So how the broker comes in is to give you leverage, okay, so that you can compete in this huge, large financial market. So the broker is actually also, risking their liquidity to help you trade in the market. Okay, so the brokerage firms are for-profit institutions. So if they are helping you trade in the financial markets, of course, they would have an avenue to make money. Okay, so before we talk about how they make money and things, the recommended forex broker of choice is TenTrade, which is a sponsor of this 2-day bootcamp. This bootcamp is brought to you by TenTrade to educate you on what the forex market is and how you can start trading, make income in the foreign exchange market. So if you are not registered as a TenTrade client, you want to go to this website, www.10.trade. You would also find a lot of information about TenTrade, and then you see the register button just at the top to create an account, right? And amazingly, every client of TenTrade has a specific account officer that will be assigned to you. So when you create an account, within 24 hours or 48 hours, you should get a follow-up call from an account officer that would offer continuous support regarding trading, deposits, withdrawals, anything concerning your skill sets, anything concerning Forex, your account officer would help you out. So you want to go to this website, and very, very importantly, TenTrade is a very, very creative brokerage firm. They offer very, very tight spreads, fast deposits, fast withdrawals. Everything is intact. Unlike a lot of unsuspecting brokers out there, TenTrade is actually very, very different and unique. They put the client first and ensure that you are well taken care of. And of course, a lot of promotions are always ongoing if you trade with Tendry. So you don't want to miss out on what Tendry is offering. So again, if you've not already started, you want to go to this website, www.10.trade. Okay, moving forward. Let's talk about what is traded in the foreign exchange market. What do we trade in the foreign market? Of course, I've given you a clue. We say that currencies are what is being traded in the foreign exchange market, right? So every currency in the world is being traded in the market. As long as these currencies, currencies are specific to countries. Now, as long as these countries are having trade interactions with other countries, with other currencies, okay, every transaction will reflect in the foreign exchange market. Okay, so we have currency like the euro, like the British pound sterling, the Australian dollar, the New Zealand dollar, the US dollar, Canadian dollar, the Swiss franc, the Japanese yen, okay, the South African rand. But these here are the 8 major currencies. Okay, we have, I think, over 100 currencies, okay, available for you to trade. But the currencies where you find, as a trader, where you find the majority of opportunities to trade, where there's defined market structure, right, are the 8 major currencies. Excuse me. Okay, so you have the euro, the GBP, AUD, NZD. Okay, good. So let's talk about currency pairs. Now, if you are trading in the foreign exchange markets, we don't trade individual currencies. We trade currency pairs. So we trade a currency against another currency. Remember, in the foreign exchange market, we are trying to capitalize on the volatility in the market. Okay, because exchange rates of currency pairs is not static, it is always fluctuating. As a trader, we want to make money from the fluctuations that happen in price. Okay, and that price is exchange rates of currency pairs. Okay, so that is why we do not trade individual currency. We trade currency pairs because only currency pairs can have an exchange rate. Remember, when we say something is an exchange, that means we're exchanging from a particular thing to something else, right? So a currency pair in the Forex market, we trade currency pair. Okay, so this is a currency called Euro USD. Okay, so this is the euro against the US dollar. Okay, so let me back up a bit. Now, these are the 8 major currency pairs. So 8 major currencies, I beg your pardon. So when we are talking about currency pairs, it's simply pairing each of those currencies against another. All right. So that means we can pair the euro against every other major currency pairs here. So for example, the euro and the GBP is euro GBP. The euro and the Australian dollar is euro AUD. Okay. Example, the British pound against the Swiss franc is GBP CHF, right? So when you do some sort of a combination or a permutation of 8 of these major currencies, you should arrive at about 28 currency pairs. Okay, so when you pair each of these currencies together, okay, so these are just major currency pairs. Okay, we also have a lot of currencies that you might find interesting as you grow in your knowledge of Forex trading. All right. So every currency pair is made up of two currencies. The first currency in a currency pair is called the base currency. In this case, the euro is the base currency. All right. And the second currency on the right-hand side is called the quote currency. It's called the quote currency, and then this is the exchange rate. So every currency pair has an exchange rate. So the exchange rate is the rate at which you buy or sell that particular currency. Okay, so in this case, this is the exchange rate. Okay, so what that means is that simply in this case, this is just a random figure. Now, so in this, so if Euro USD is 1.1302, what that means is that 1 euro is worth 1.1302. Okay, that means the euro is higher than the dollar. So that means 10 euros will be 1.1302 times 10. It's as simple as that. Okay, so we'll get into practicals shortly tonight, and then we'll conclude the majority of our practicals tomorrow. So tomorrow will be majorly for practicals. So let's use today to set a good foundation, right? And then tomorrow we'll dive deep into more practicals. So let's talk about buying and selling currency pairs. Let me check something. Good. So let's talk about buying and selling currency pairs. Now, as a trader, these are the two major activities that you will be doing to make money in the market. So it is either you are buying a particular currency pair or you are selling. So remember the concept of CFD, which is contract for differences, for difference. You can make money either when price is going up or when price is going down. So when you are buying a particular currency pair, that means you are betting against the fact that that currency pair, that the exchange rate is going to go high. So you want to buy at a low price, expecting that the exchange rate is going to go up. So once the exchange rate is going up, you'll be in profit, and then you can close in profit, right? If you are selling a particular currency, that means you are betting against that currency pair that the exchange rate needs, that the exchange rate should go down. So if you sell and then price starts going down, you'll be in profit. And then according to your setup, you can close in profit at any point in time. So you are making money both ways, either when price is bullish or when price is bearish. Okay, so the market is constantly a tussle between the bulls and the bears. So the bull market is simply, so when you take a look at how a bull operates, now when a bull wants to attack, how does a bull attack? The bull attacks with his arms from down up. Okay, when you look at a bull, the bull put his head down, and then to attack, he put his head up. So it charges down up. So that's why we call it a bull market. Okay, on the flip side, a bear, how does a bear attack? A bear attacks from up down. Okay, so that's why we call it a bear market. So it is either price is in a bull market or price is in a bear market. So as a trader, you can capitalize on this market direction and choose to be a part of the bull market or a part of the bear market. Okay. And all of this is kudos to the contract for difference. Amazing concept. All right. So let's go a step further. Now we are gradually approaching the practicals. Okay. Let's talk about the concept of a peep. the concept of a pip. What is a pip? A pip is a unit of measurement that is used to show changes in the rate of a pair. It tells us how far price has moved within a particular period of time. A pip is a unit of measurement used to show changes in the exchange rate of a currency pair. It tells you how far price has moved within a particular period of time. So check this out. So we have the euro USD, the euro dollar. And then remember, we talked about the volatility that happens in the market. What it means is that exchange rates fluctuate. Okay, so the exchange rate is not usually static. So pretty much every second, you have the exchange rate changing. Now, it is changing because constantly we have trade transactions going on between each of those currencies. Okay, and that transaction is recorded very, very fast in the foreign exchange market. Okay. So a PIB helps us to measure the changes with respect to price movement. So let me give you an analogy to explain what a PIB is. So when we talk about distance, so let's say you're going from your place of work to your apartment. Okay, so those are two different locations. So the distance from your office to your apartment. Now, distance is measured in meters or kilometers. Okay, so the basic unit is meters, right? Good. So likewise, for a PIP, when an exchange rate changes from a particular price to a different price, to know how far price has traveled, we measure it in pips. It's as simple as that, okay? We measure it in pips. So let's look at this scenario. Let me bring out my pen here, okay? So let's look at this particular example, okay? So this is the Euro USD. And then what can we see? We can see that price moved from here 1.1005, and then we can see price moved here. So maybe this happened within 1 second or within 1 minute. We don't know. We don't know. But this is still a change in exchange rate, a change in price. Okay, so there has been an increase 1.1005 to 1.1006. So how do we measure the pips, the difference? It's very, very simple. So there's a manual way to do this, and then there's an automatic way to do this when we start using. So later on, I will introduce you to a platform called the MetaTrader platform. So on MetaTrader, there is a tool on that platform that can easily help you measure the difference. But as a forex trader, it's good to know these things. So you can also calculate it manually. It's very, very simple. So let's do the manual calculation real quick. So for any pair, any currency pair, except from JPY and gold. Gold is not even a currency pair. Gold is an issue. So any currency pair except from JPY, okay, we want to look at the difference between the exchange rate, and then we'll round it up to the fourth decimal place. So here's what I'm talking about. So when you subtract, so price moved from 1.1005 to 1.1006. all you have to do is to subtract this from this. So when you subtract this from this, we should get 0.0001. Okay, so that is the subtraction. So when you calculate 1.10 minus this, so for every currency pair apart from JPY pairs, okay, you want to move this decimal to the fourth decimal place. So so 1, 2, 3, 4. So the decimal point will be here. So right now we would have 1.0 pip. So this is 1 pip. So this is how we do the calculation. Okay, we are concerned about the fourth decimal. Okay, so this is how you do your calculation. You just simply subtract the starting exchange rate to where you are calculating the end, subtract, and then you move decimal 4 places forward. It's as simple as that. Okay, now let's do for these other, let me delete this. Let's do for these other pair. Now we have a pair USD JPY. For currency pairs that has JPY in it, any JPY pair, we calculate it differently. We calculate it to two decimal places. Okay, 2 decimal places. But for every other pair apart from JPY pairs, we want to calculate it 4 decimal places. Okay, so in this case, let's say price moved 1.104 from 104.20 to 104.21. You want to simply subtract this from this or this from this. So this will give you 0.01. So because it is JPY, you move it 2 decimal places forward. Okay, simple math. Just simply move your decimal place, just multiply by 100. Okay, so 1, 2. So this will now be 1.0. So this is how we got 1 pip. Okay, so regardless of the number here, this is a calculation. So this is how you calculate pip to know how far price has moved from one point to another. Okay, so let's do this in real time. Let me take you to the MetaTrader 5 platform, and then let us look at how pips move, how price moved in pips in real time. So this is MT5 platform. So this is a trading platform which we'll still talk about later in this session. But just to explain what we're doing when it comes to pips. So let me give an example here. So price moved at a particular point from here. So let me bring back a notation. So price moved from this point to this point. Okay, so this happened a few minutes ago. So, and we want to measure the distance, how far price moved from here to here. Okay, so the movement is measured in pips. So let's do that real quick. So let me put a line there to signify this, right? So remember, I was talking to you that for MT5, for MetaTrader 5 platform, there is a tool that can help you measure pips. Okay, but before we use that tool, let's do this by ourselves. Okay, so we have this right here. All you simply do is to get the values here, the exchange rate of this starting point to the end point. So let me bring out this. So here we have, so the exchange rate here is 1.04702. So let's have that in white. Good. So this is the exchange rate. And then for this one at the top, we have over here, this is 1.05091. Good. So now we have the exchange rate of these 2 points. So all you simply do is to subtract. So we are subtracting this exchange rate from this. So just simply go to your calculator, okay, to do that. And what are we going to have? So let me do that real quick. So 1.05091 minus 1.04702. So this would give us, when you subtract this would give us 0.00389. Okay, now because this is Euro USD, we want to move the decimal 4 places forward. So when we do that, we are going to have, okay, 1, 2, 3, 4. So this will be 38.9 pips. 38.9 pips. So distance from here to here is 38.9 pips. Okay, quite easily done, isn't it? Okay, so let's confirm this by using the tool. Now there's a tool called the crosshair. The crosshair, let me take this, is right here. It looks like a cross sign here. Okay, so you want to come to your MT5 platform and then just simply select that tool. So that tool, you can see, helps you measure. So you start from the starting point over here. So from here, then you just simply drag it to this top. Okay, and then what can you see? You can see it now. The crosshair is measured in points. So over here, you can see 390 points. And this is because we did not really put it on the exact line, right? But 390 points. So the value that you get, you just divide it by 10. So 390 divided by 10 is what? Is 39, okay? Which is the same thing as, 38.9 pips. So just simply get your crosshair from here, you take it here, okay? And then the value that is in points, you just divide it by 10. That will give you the value in pips. It's as simple as that. So when you use the crosshair tool, you won't need to have to do any mathematical calculation. But as a forex trader, it helps, okay? It helps because when you are trading from your phone, and then you want to quickly measure pips, the MT5 on a phone does not have a measuring tool. So you might have to use, your understanding of how to calculate pips to do it as soon as possible. All right. So it's something basic that you need to, learn. And this explanation, you can easily grab it. Okay. Just simple subtraction. So let's go back to our slide. Okay, so back to a slide of pips. So we talked about a pip. We use pip is a unit of measurement. So we use a pip to measure how far price has moved within a particular period of time. All right. So all of this that we have been learning is going to and it's going to come together for you in a short while. Okay. So let's talk about spread. Remember when I was talking to you about Forex broker. Now, Forex broker makes it possible for retail traders to trade in the foreign exchange market. And I told you that the Forex brokers are a for-profit business enterprise, right? And then for them to help you trade in the foreign exchange market, okay, remember they are giving you leverage. Ordinarily, you cannot trade. Ordinarily, most retail traders cannot participate in the foreign exchange market because of the huge risk and then the huge capital that you need to really compete. Okay, so they match your capital with their own capital using leverage, and then they help you trade. They do a lot of transactions for you to ensure that your trade is placed at a very, very good price, and then you also get your profit. So they do a whole lot. So in order to do that, okay, there's something called spread. So spread is pretty much a compensation or how most forex brokers make money. So a spread is the difference between the bid and ask price. So I'll show you this also in a while. So this is the bid price. Okay. So bid and ask. So if we want to, if you are trading, let's say Euro USD, and you want to go long, for example, you want to buy this particular currency pair. And let's say this is where price is right now. So at a particular time, at every time when market is active from Monday to Friday, you will always see bid and ask price. Okay. So bid price is the price where you as a trader can sell any particular price. So this is price where when you sell, this is where your entry will be. If you want to buy, so buy is ask, right? So this is the price available for you to buy that particular currency pair. Okay. So at every particular time, you can see there's a difference there, difference between, so for this particular, at this particular period of time, to sell a particular currency pair, this will be the price where your quote will be. This is the price where you'll be quoted in. And then to buy, this is where you price quoted in. So the difference between this and this is the spread. Okay, is the spread. So this spread is also measured in pips. All right. So spread is how most brokers make money. So this is 1.5. So when you subtract this from this, right, you get 1.5. So as a matter of fact, let's subtract it just to be sure. 1.3085, 1.30855 minus 1.3087. All right. Good. So when you subtract this, you get 0.00015. So let's assume that this is Euro USD, EU. You simply move it 4, which is 4. So 1, 2, 3, 4. So that is 1.5 pips. Okay. So spread again is a difference between the bid and ask price. All right. So this is how the broker can, because brokers are also because a lot of liquidity is needed to trade liquidity, I mean money, is needed to trade directly in the foreign exchange market. The brokers are also buying this particular currency pair at a particular time. So at a particular price, I beg your pardon. So they wouldn't give you the same rate at which they are buying. And also they won't give you the same rate at which they are selling. So that markup, right, is a spread, right? So we don't want to go too deep into spread, but just have the back of our mind that the spread is a difference between the bid and the ask price. And then the bid is the price where if you want to sell any particular currency, this is the price where you'll be quoted. If you want to buy a particular currency, this is the price where you'll be quoted in. Okay? Simple as ABC. So for every trade that you place in the market, there's a spread for that particular entry, for that particular trade to process. So for them to process your trade, you need to use a spread. Okay. So moving on, we'll talk about lot sizes real quick. So before I talk about lot sizes, let me quickly show you in the Forex markets, the bid and ask price that I was talking about. So over here, so this is your MT5 platform. You can see Euro USD over here. You can see it's constantly fluctuates. So this is Euro USD. See, and then you have the bid price here, and then the ask price here. So if I want to sell, you can see it's changing constantly because the market is fluctuating. So if I want to go short on Euro USD now, this is a price where I'll be quoted in based on how fast my execution is. If I want to buy Euro USD, this is a price where I'll be quoted in based on market execution. Okay, simple as that. So you can see constantly changing, and because of different liquidity providers, most forex broker, every broker rather would have a bit a little difference in the bid and ask price, almost negligible, okay, but different. So every forex broker will not give you the same bid and ask price because they have different liquidity providers. Okay, good. So let's go into the next concept, which is a concept of lot sizes. Let's talk about lot sizes. Okay, so this is this is an interesting concept that you'll be very interested in. So now a lot is the number of units of base currency that you can buy or sell at a time. Okay, lot size is the number of units of base currency that you can buy or sell at a time. So I would say the easiest way to explain lot sizes to you is to, let me bring my notation here. The easiest way that I can explain lot size to you, when you think about lot size, think about volume. Okay, there's a lot of mathematical calculation with lot size, but I don't want to bore you with all of the calculation. So I'll be very simple as much as possible, not to confuse you. Now, lot size, think about volume. Volume, think about how much of your capital that you are staking on a particular trade. So let's say you have a capital of $1,000, and then you want to trade Euro USD. Okay. Now, for you to trade Euro USD on MT5 platform, you will be asked for the lot size that you should use. So the lot size that you should use is what we're talking about right here. So lot size determines how much of your capital are you going to be trading with in the foreign exchange market on that particular trade. So basically, we have four categories of lot size. Okay, the list being we have the nano lot, we have the micro lot, we have the mini lot, and then we have the standard lot. Okay, so the lowest lot size is the nano lot, which is, so focus on the volume aspect here. This, right? Don't bother to about units. I don't want to complicate this, but focus on volume. Now, the lowest volume that I can trade with is a nano lot, which is 0.01. Right now, most brokers don't even offer nano lots anymore, except on their MAM or PAM account, but something accessible to traders who trade directly. Okay, so most brokers will start from the micro lot. So micro lot volume 0.01. So let's say you have capital of, again, $1,000. Okay, and then you want to take a trade on Euro USD, and you want to trade a micro lot. Now, a micro lot, the least volume is 0.01, right? So from 0.01 to 0.09, okay? Everything here falls in the category of a micro lot, right? From 0.1 to 0.9, this falls into the category of a mini lot, to 0.99. From 1.0 to, this is this depends on broker. So on the broker. So let's say some brokers will give you a maximum of 1,000. Okay, so let's say from 1 to 1,000 lots. This is what? A standard lot. Okay, so what does this mean? So if I'm trading, with a micro lot, if I'm trading with a micro lot of, let's say, excuse me, if I'm trading with a micro lot of 0.01, which is the least volume in the micro lot category. Now, what does this mean? For most currency pairs, so let's do a round figure now. What this simply means is that the value of my PEEP for each PEEP in the market, you just simply multiply this by 10. Okay, you multiply by 10, and then when you do this, this will give you what? 10 cents per PEEP. Okay, so what this means is that if you are trading with the least lot size on the micro lot of 0.01, it means that your volume, or what you are staking, your risk on that particular trade, is what? 10 cents per PEEP. So every PEEP for you using this lot size is what? 10 cents. Excuse me. So every pip is what? 10 cents. If you use a micro lot of 0. Let's say 0.0, let me remove this. So I use a lot size of 0.08. This means the value of a pip is 0.08 times 10. So this is 0.80. So that is 80 cents per pip. Okay, so let's say price moved your direction. Let's say you bought Euro USD at a particular price. And then let's say you bought somewhere here and then price went all the way up here, from here to here. So this movement, so let's assume this is 20 pip move. Okay, so this was a point of entry, right? Entry, and this was your point of exit. So if you used 0.01 here, so let's have 0.01. This is 10 cents per pip, right? 10 cents per pip. So for this particular trade scenario here, that you made a profit of 20 pips, if you use a lot size of 0.01, your profit is going to be what? The value per pip, which is 10 cents. So that would be 0.10 times 20. Okay, and that'll give us how much? That will be $2 profit. So your profit on this trade here is going to be $2. But let's say you use a higher lot size. Use a lot size of 0.08. For this same trade, if you use 0.08 here, that will be 0.80 times 20. And that will be how much? That will be $16. And that's because you use a micro lot. Okay, let's do another calculation real quick. Okay, so that's for micro lot. Let's do for a mini lot, which is the next category of lot sizes. All right, so like I said, a mini lot starts from 0.1 to 0.99. So if you use the least mini lot, so that's 0.1. So if you are taking entry with 0.1 lot size, okay, what it means is that, so let's say you are trading Euro USD. So you just simply multiply this by 10. So the value of every pip based on the lot size is $1. $1 per pip. All right. So for this move right here, for this 20 pips move right here, you took entry here with 0.1 pip, with 0.1 lot size. So that means the value per pip is what? $1 per pip. And then price moved 20 pips. So in this case, this will be $1 times 20 pips. So your profit on this trade is going to be $20. Does that make sense to you? And then this goes both ways as well. So if this trade goes in your favor, you would make $20 in profit. If it goes against you, you would also make $20 in loss. That's if you exit 20 pips below your entry. Remember, price can go your way or go against you. Okay, so that is why we are studying the skill set of the right time to buy and sell in the market. Okay, so that is how we calculate lot size. So lot size gives perspective to pips when you are taking entry. Okay, so lot size is really what will determine the value of every pip and then how much you can make in the market. So that's like a basic concept. So if you're using a standard lot, for standard lot, you have 1.0 to, let's say, 1,000. This is a variable, depends on the broker. Okay, so if you sell a lot, if you sell a lot of, let's say, 5.75 lots, so the value of this 5.75 lots is just simply multiply it by 10. So that will be 57.5 dollars per pip. So if you have a 20 pip move, so that will be 57.5 times 20. That will give us how much? Let's call it that real quick. Okay, 57.5 times 20. So that will give you 1150 profit. That's if price goes your way. If price goes against you, you make this in a loss. Okay, so plus or minus. So it depends on how price moves. Okay, but of course, we want to make profits, and that's why we are starting from the foundation. So these are basic concepts that you must put to heart. And then when we start talking about risk management, you will know exactly the lot size that you should use based on your trading capital. All right. So if you are trading with $100, for example, it's best to start with micro lots. Okay, but depending on your leverage that broker gives you, also depending on your goals, right? You can use a mini lot or a standard lot, but that will mean that you'll be risking more. So let's say, for example, you have an account of, let's say, $500, and then you use a standard lot. So when you're taking entry, you take entry with 1.0. And that means what? That means $10 per trade, per pip. So let's say price moved 20 pips against you. Okay. With a 20 pip move against you, right, is going to mean that you'll be in a loss of $200, which is what? Almost half your capital. Okay, except you are planning to compound your account, or you're trying to maybe flip your account, you might be very, very aggressive. All right. So some traders are aggressive, some are conservative, some are extra conservative, some are moderate. So based on your kind of person, okay, you will know exactly the right lot size to use. So let me take you to the MT5 platform and then show you all of this in real time. Okay, so let's go to material 5. So MT5 for short. So this is a trading platform. Of course, we'll see delve deep into this. So this is where we take entries. This is a platform where we do analysis as well. Okay, so let's say we want to take an entry, for example, on Euro USD. Okay, you click on new order at the top here. So you can see you'll be asked for, over here is called volume. So this volume here. So this is where you put the lot size that you want to use. Okay. And as you can see over here, so let's say I want to use a micro lot. So say I put 0.02. Okay, so this is my lot size. All right, and then we'll talk about this maybe tomorrow or today. You have stop loss, you have take profits, and then you'll be asked to sell or buy. So based on your analysis, once you've done your analysis, you will know exactly what you should do, right? So you click on sell or buy. Okay, so let us do something random, right? So let's just click on buy, for example. Okay, so you can see immediately we're put into the market. All right. So this is a price where I was quoted in the market here. Okay. So for some reason, hold on. And then you'll be seeing how much you are making or not making. Give me a second. This is not, I should see my profit. So I think my MT5, maybe because I'm sharing my screen. Now over here, I should be able to see my running trades and also be able to close it, but it's not showing. Give me a second. Let me try to adjust this. I think there's something wrong with my screen adjustment. So, but when we start talking about MT5, I'll show you all of this properly. You see how much you are making in profits and then how much you are also losing. But you can see your volume will be there. And then based on how price is moving, you'll be able to see everything as it is going. Hope that makes sense to you. I would really love to fix this right now. Give me a second, guys. Let me see if I can fix this now. Okay. Okay, so I think I'm gonna have to do this possibly after this session. Okay, good. So let's move on. All right. So let's go to the next concept. Let's go straight into next concept. All right. So next concept is Forex trading sessions. Okay. We have Forex trading sessions. So remember that we talked about the fact that the market is open Mondays through Fridays, right? It's open 24 hours from Monday to Friday. Majorly open work hours when market starts. Okay, so this 24-hour trading period is broken down into Forex trading sessions. And because we trade in the currency market, we are trading volatility in currencies. And when you look at it, the country or the continent that's ahead of everybody is Australia. So it makes sense. Australia is the first country to start business operations. All right. So that's why we break down trading sessions into when some currencies are active. All right. So there are four major trading sessions. You have the Sydney session, you have the Tokyo session, you have the London session, and then the New York session. Now, this time that is here, okay, is depends on your own time zone. rather. Okay, so right now I'm in Cyprus. That's why I'm using this particular time. So if you're in Nigeria or you are in the US or you're in London, just simply convert this time, Cyprus time, to your own time. You will get the time based on your time zone. All right. So in the Sydney session, basically, currencies in Sydney session that are mostly active would be the I think that would be the New Zealand dollar. That would be the or the AUD. Okay, so because this is where these currencies will be mostly active because because people are actively trading the currency because work has started. Now, this does not mean that every other pair wouldn't be active here, but majorly you see moves on this pair. Okay. For Tokyo, we would have the Japanese yen will be more active. And yeah, I think just JPY is Tokyo, Japan. Then for London session, you have the Euro, EUR, and then you have the GBP. You have GBP, and then I think we have the Swiss franc as well, are mostly active in this session. For New York, you have the US dollar, majorly North America of US dollar, and then you have the Canadian dollar. Okay, Canadian dollar, mostly active. All right. So as you develop your skill set in Forex trading, you naturally find affinity to trade specific sessions. All right. So the majority of people like to trade in the London session and the New York session because most of the major currency pairs are active within this period, right? So, and usually we have a lot of peep movement with respect to currency pairs in this session. Okay, so most traders like to trade within the London session and the New York session. But you as a trader will decide what works best for you. Some like to trade Tokyo, some like to trade Sydney. So you will know as you learn the time frame that you like to trade. Okay. So and then your work or your life schedule can also influence the time zone, the sessions that will be convenient for you to trade. Okay, good. So that's that about Forex trading sessions, right? So let's go into the next concept. Let's talk about candlesticks anatomy. Now, let me take you back into the MT5 platform, right? So we have this, all of these green and red thing that you're seeing are called candlesticks. Okay. Now, this is what you will be doing as a Forex trader, understanding these candlesticks. All right. So let's just talk about what these candlesticks mean shortly. Okay. So, give me a second. All right. Good. So, let's go back into the slide. So remember, we talked about two major moves that price make. It's either price is going bullish or price is going bearish. So a green candle, now, when you saw my chart, you saw green and red candles, right? You can actually customize the colors to whatever you want to use. You can change the green to red or change the red to yellow or whatever you want to use. But when you see price being bullish, okay, so we have a bullish candle and then we have the bearish candle. right? So in my case, I put green as bullish and I put red as bearish because it doesn't make sense to me visually that way. Okay. So how do we make sense of these candles? So for the green candle, it signifies for a bullish candle, it signifies an increase in price. It signifies price gaining strength or an increase in exchange rates within a particular period of time, right? So when you see a bullish candle, just know that, okay, exchange rate has gone up within that particular time frame. When you see bearish candle, know that the exchange rate of that particular currency pair has gone down in that particular time, right? So over here, the anatomy of a candle, for a bullish candle, we have the open price. So over here, at this point in time, this is the price where this candle opens. So this is the open price. So when price opened here, right, and then we have over here, you have the low price or the lowest price. And then, so a lowest price means that when price opened here, before it started going up, price, first of all, went all the way down. So price went down and came to this price point, but it did not stay there. It did not stay there. So it came here and then price started going up, gained momentum, okay, came up here. And then we have the high price. So price came up and came to this high price here. So high or highest price. So this is the highest that price came to within that time frame. And then, but price came as high as that, but did not stay there. Rather, when it came up, started going all the way down. And then eventually there was a close at this price. So a candlestick is made up of low price, of open price, low price, close price, high price. Okay. Or you say O H L C. And then the open price to the close price is usually called the body of the candle. Is the body of the candle. And then this high price here, these lines here, this black line, we call it the wick. Okay, the wick. On the flip side, for a bearish candle, on the flip side, a bearish candle signifies a loss in momentum. Okay, so it means that in that particular time frame, the exchange rate went down. So for a bearish candle, this is start from the open price. So price will open at this particular time, this particular zone in the market. Okay, this is the high price. So when price opened here, possibly you can see price came all the way up, but it did not stay up, started going back down. It went down and then it came to this low price here. But price did not stay at this zone. It came all the way back and then closed here. All right. So this is happening because of the fluctuation. So every fluctuation in price movement is recorded. So the candlestick helps us to record fluctuations in price. It gives you a visual representation of price. So when you look at a chart and then you see candlesticks just like this, let me go back to this. When you go to a chart and then you see candlesticks just like this, it helps you understand what is happening on that particular currency pair. So this is the Euro USD, for example, on the 1 minute time frame. So the good thing is that with trading platforms like MetaTrader, you can know exactly how price is doing based on different time frames. So maybe you want to know how price is doing every minute or every 5 minutes or every hour or every day or every 4 hours. You can actually change the time frame from here. Okay, but this is on the 1 minute. So that means every candle here represents 1 minute. Every candle here. So you know what price is doing per minute. And then as you can see, price overall has been going down from here. Price went up like this. Price went down like this. Went up, went down. You can see it gives you a visual representation of the movement of price. And then this movement of price, this chart here will help you aid, will give you, will help you analyze the market. It will help you make your analysis and make future projections as to what price wants to do. It will also help you know what price has done in the past. Okay, you can see when you go all the way back, you see what price has been doing in the past. And then this will help you know exactly what might happen in the future. All right. So this is a chart on the 1 minute of Euro USD. If you change it, for example, to the 4 hour chart, you see a different market movement. Okay, so on the 4 hour chart, now you can spot the difference. You can see how different this is. Okay, because right now on the 4 hour chart, every candlestick represents 4 hours. Okay, represent 4 hours. So good. So that is how we look at candlestick anatomy. Okay, so when we start doing analysis, we start talking more about candlestick, and then you get a deeper understanding of candlesticks. Okay, so let's go to back to the slide. All right. So trading platforms. So good. So this is MetaTrader 5. So this is where we do our analysis, and this is also where we take our trades from. Okay, so we do analysis and then we take trades. So I've shown you a few things. I've shown you a few things, right, on MetaTrader 4, on MT5 rather. So you can also download this on your phone. So you want to go to your Google Play Store. Right now, MT5 is not available on iOS. It was recently removed because MetaTrader is a Russian company, and I think because of the war, the Russian and Ukraine war, iOS is a US based company. So iOS is trying to cancel. I mean, Apple is a US company, and they're trying to cancel Russian companies based on due to the sanctions, the US government sanctions. So right now, MT5 is only available on Android, on Android phone. Okay, so it is either you trade using your Android phone or you download MT5 for your PC. okay, for your PC. I think there'll also be a way where you can download it for your Mac as well. I'm not exactly sure, but there should be ways where you can make this happen. So just want to do your research. So all you have to do right now is on your phone, Android phone, go to your Google Play Store and then download MetaTrader 5. Okay, so there's only one MT5. Okay, so download it. When you got to get the PC version, just go to Google and search for this. You see the website to download it from. So when you download it, okay, you will log in. So that's what you want to do. And then the next thing you want to do, if you've not, if you don't have an account now, for you to trade on MT5, either on demo or a live account, you need a Forex broker account. Remember, we talked about Forex broker here. Okay, so our recommended Forex broker is 10Trade. And then to create an account on 10Trade, you want to go to this website here. So let me just walk you through how to create an account on 10Trade, and then possibly how your dashboard will look like. Because tomorrow, when we start going into practicals, right, I want to show you how to open a trade on your platform and then how to do something. So between now and tomorrow evening, you want to have created your 10Trade account, log in, create a demo account, and then log in. So let me go to my browser right now. I'll go to my browser right now, and then I'll show you how to create an account on 10Trade, and then how to create a demo account, and possibly how to log in to your account as well. So let's go to 10Trade real quick. So you want to go to www.10.trade. Give me a second. So go to 10.trade. So when you do that, you wait for the website to load up real quick. So this is how the website looks like. Very, very beautiful website, isn't it? Now, once you do that, you want to click on register. Okay, so click on register. Of course, you can take your time and also go through everything that we offer on 10Trade. So you want to click on register. All right, and then you want to register with these details. All right, so register as an individual client. If you are one person, you put your name, your last name, your date of birth, okay, your country of residence, and then you click on continue. It's as simple as that. Under 1 minute, you are done. And then one thing to note is that when you register, your login details will be sent to your email address immediately. So that is your details to log in into your dashboard. So over here, because the next time you want to log in to your dashboard, you need to come to the website, click on login, and then you'll be asked for your email and password. So the password would be sent to your email as soon as you fill that form. So just simply put your email, password, and then you click on login. Okay, so let's click on login real quick. So when you log in, like so, all right, you will see this. This is your dashboard. So this is your cockpit. This is where you do all the operations that has to do with your trading. All right. So the first thing you want to do is to do your KYC verification. I recommend do your verification. All right. So So you have to upload your proof of ID and address. So because I've done that on this particular account, you will see it at the top, and then a link to verify your account will be here. So once you've done that, while you're doing that, you can also open a demo account or a live account. So to open a demo account, you click on open demo account. All right. So click on demo MT5, leverage. Okay, use 1 to 100, currency USD. So over here is where you can set your initial balance. Okay, so let's use 1,000, and then you click on continue. All right, you can continue. Good. So this right here is your demo account login details. So a demo account is a practice account. Okay. A demo account is a practice account. So before you start trading live, right, it makes sense to test the market and see how to trade. So this is where you do all of your, testing. All right. So you have all of your details here. So these details is what you use to log into your MT5. All right, to log into your MT5. So how do you log into your MT5 on your, so let's do this on the platform. So let me go back to the platform. So this is the MT5 platform. To log in, you want to just click on file, okay? Then log in to trade account. So depending, so if you are doing this newly, you click on open an account. And then the first thing you want to do is to add the broker here. So just come to this box and then search for 10Trade, and then click on find your company. Okay, so 10Trade will come up here. So click on 10Trade and then click on next. Okay, and then you select connect with an existing trade account. So when you click on that, then you put your login details here, your login and your password. Your login in this case will be these details here. This login 42581, and then the password. So in order for you to trade, you will see two passwords. The one you want to use is the first password here, not the investor password. So you can password, then 42581 is the login. It's a fairly simple process. Login 42581 and then password. Let's just paste it there. Server, leave it as this, and then you click on finish. You see? So you can see immediately. Good. So you have this here.
Incoming mail.
Good. So you can see your balance $1,000. So this is your MT5 account. So we need this account for tomorrow. By tomorrow, we'll start placing trades. So your assignment between now and tomorrow is to create your broker account, start a verification process, open a demo account, and get set for tomorrow. So tomorrow we'll run more practicals for tomorrow. Okay. If you have any questions, so this is where we'll stop for tonight. If you have any questions, you want to hold this question for tomorrow, and then I'll be here to answer all of your questions. All right. I hope you learned something this night. If you learned something, why not share it on social media? Let us know. Tag 10Trade on your Facebook, on your Instagram, your what you learned this night. Let us know, and I'll catch you tomorrow. Have a remarkable night rest. Cheers.